Question 81. Which of the following is referred to as the capital market line? A, the capital allocation line considers only the risky portfolio as the optimal risky portfolio. So we can rule this out. It doesn't consider only the risky portfolio as the optimal risky portfolio. It could consider, depending on the investor, some combination of the risky portfolio and the risk-free portfolio. It doesn't have to be only the risky. And then B, the capital allocation line uses the market portfolio as the optimal risky portfolio. That sounds like a better answer so far. Let's see what we have for C. Capital allocation line uses the risk-free portfolio as the optimal risky portfolio. Well, a risk-free portfolio is not risky, so we can go ahead and rule out C as well and confidently come back and go with answer B here. Question 82. Which of the following investors most likely has a portfolio perspective in his investment strategy? So portfolio perspective, meaning we take into account a holistic view of our portfolio, the different positions, asset classes in there, in the way we invest. Investor A has been investing in the shares of MaxMart for the last 10 years. He always earns above market returns because he regularly evaluates the risk and return of his single asset portfolio. So one asset is certainly not taking into account a portfolio perspective. I'd argue this is more like speculating in one company, and this one company has done well over time, so they've gotten lucky, but this is definitely not taking a portfolio perspective. Number 2, investor B holds a PhD in economics. Due to his sound knowledge of different sectors of the economy, he keeps shares from different firms from different sectors. Sounds like he's more diversified. He evaluates the combined risks and returns of these assets in a portfolio. So that's key here. So he's evaluating combined risk and return of the assets in the portfolio. He's diversified and buying different shares in companies across different sectors in the economy. Sounds like investor B is good so far. And then for investor C is a new investor who recently started investing in some large cap stocks. His investment strategy involves evaluating the risks and returns of his portfolio shares in isolation. So this is going to mean the isolation is where this falls apart here. It's good that he's buying multiple stocks, it sounds like, for some diversification. However, considering these different stocks in isolation without understanding what it could do to the risk and return profile of his overall portfolio and strategy means he's not taking a portfolio perspective. So we've got investor A, which we can rule out, investor B, and then both investors B and C, we can rule that out as well and go with B, investor B. Question 83. 2 portfolios have the following characteristics. So we got A and B here. We got return and beta. Given a market return of 10% and risk-free rate of 4%, calculate Jensen's alpha for both portfolios and comment on which portfolio has performed better. All right, so Jensen's alpha, that formula is going to be the return of the portfolio, and then we're basically subtracting out what the return should have been under CAPM based on their beta and the market's return. So return of the portfolio is going to be this first column here. So we'll have 8% for A and 7% for B. And then subtracting out then risk-free rate plus beta times equity risk premium. And equity risk premium is going to be 10% minus 4%. So return above risk-free rate. So we've got 4 and the risk-free rate and the equity risk premium are going to be the same in both instances. The difference here is the beta. So portfolio A ends up at minus 0.2 and portfolio B ends up at minus 3.6. So investor A has done a lot better. They both have negative values, but minus 0.2 is a lot better than minus 3.6. So we've got A, minus 0.2 and minus 3.6 respectively. Portfolio A has performed better than B. That sounds like it's our answer. For B, we've got 0.2 and minus 10.6. We can rule that out. And then C, we've got 8.2 and 10.6. We can rule that out as well. Answer A. Question 84. An investor has purchased shares of a large cap equity stock. The covariance of the stock with the market index is 0.032, with the standard deviation of the stock in the market index of 22.5 and 15.7 respectively. The return of the large cap equity stock most likely follows a trend which A, follows the general market, B, resembles the general market, or C, moves opposite to the general market. So to answer this, I think it makes sense to calculate correlation. And since we're given all the variables to calculate that, so that's going to be the covariance of these two and then divided by standard deviations multiplied together in the denominator. So when we do that, we get a correlation variable of 0.9059. And so remember, the correlation scale goes from -1 at moves in opposite direction up to +1 at the highest. So this is indicating a very high correlation between this, this stock and the market. So we can rule out C right away. We're not moving in the opposite direction. We're moving in the same direction. So then between A, follows the general market, or B, resembles the general market, I think we would lean towards A, follows the general market, and that's what correlation would imply. It would imply that they're moving in the same direction. However, with the differences in volatility being 22.5 and 15.7%, the magnitude of these moves in the large cap equity stock is going to be much greater than the general market. So the basically the beta is higher. And so I think we could say that it follows the market, but it's not going to resemble the market from the standpoint of magnitude of moves. It's going to be a lot different. Answer A. Question 85. From an employee perspective, one difference between defined contribution and defined benefit plan is that in the case of the latter, so the latter being defined benefit plan, A, future benefits are undefined. Well, we can rule that out right away. It's right there in the name. Defined benefit. It's not an undefined benefit, it's defined. So regardless of how the investments do for the employee, they're going to get that same amount of money no matter what, based on however long they worked and their salary and whatever other things go into calculating that for their plan. B, investment risk exposure is low. This sounds like it could be our answer. From the employee's perspective, like we were just talking about in A, regardless of what the market does, we are going to have that same payout. So if the market does really, really well, then the company's going to have to contribute less or keep returns. If the market does really, really poorly, or whatever they invest in does poorly, then they're going to have to make up that difference in contributions potentially. But from the employee perspective, they should be getting the same amount of benefits regardless of what the investment does. So I think B is going to be our answer. Let's make sure we can rule out C though. Employees are required to contribute a portion of their wages each period. In defined benefit, contributions are normally going to be on the employer. They may technically be pulling some of the employee's compensation, but normally contributions are each period. That's going to be more of the defined contribution plan. So we'll go with answer B. Question 86. What are the most likely implications for investors using the Markowitz efficient frontier for making investment decisions? So I'm going to pull in the efficient frontier. So we have that in front of us as we are looking through this. Let me make it a little bit smaller. So we've got A, the slope of the efficient frontier is concave. That sounds like it's correct so far. This is what the concave would look like. Convex would be this way. So it looks like A is going to be our answer right off the bat. Let's make sure we can rule out B and C though. B, investors are rewarded with increases in returns for assuming more risk. This is going to be incorrect, and that's basically why the curve does become concave. As we go out for more risk, we're having decreasing increases in return. So the marginal increase in return is less and less as we go further out on that risk curve. C, portfolios to the right of the global minimum variance portfolio are the most efficient. So this is going to be incorrect. Minimum variance portfolio is going to be about right here, since it's the furthest point left, so lowest risk. And anything here to the right of this, these are going to be more efficient. Anything on the line is going to be considered to be the most efficient. Anything to the right or down this way on the curve is going to be less efficient. So we can stick with answer A. The slope of the efficient frontier curve is concave. Question 87. Portfolio A and Portfolio B generate a 9% return. Portfolio A has a Sharpe ratio of 1.15, while Portfolio B has a Sharpe ratio of 1.05. Based on this information, which portfolio is most likely the better investment? So if we look at that Sharpe ratio, the Sharpe ratio formula, it's return of the portfolio minus risk-free rate, so it's basically excess return, divided by the standard deviation. So if they both have a 9% return, and they're both using the same risk-free rate, the only way that portfolio A could have a higher Sharpe ratio than portfolio B is if it has a lower standard deviation. So if we're looking at portfolios that have the same level of return, but one has a lower standard deviation or lower risk or volatility, all else equal, we're going to prefer portfolio A as our investment there, since we can get the same return for less risk. Answer A. Question 88. A portfolio consists of 30 assets with the average correlation being 0.75 among all pairs of assets. The average variance of each asset is 0.0675. Assuming equal weights, the risk of the portfolio will be closest to. So we've got a big, long formula here. Not that long, I guess, that we're going to walk through. So the risk of the portfolio. So this is going to be, this is variance. And so in the end, to get risk of the portfolio, we are going to need to take the square root of this whole side. But looking at what these variables are, so this right here is going to be the average variance of the assets. And then we're going to be dividing that by n, which is 30. And then we're adding that to n minus 1. So 30 minus 1 divided by 30, and then multiplied by the covariance. And in this case, we're not given covariance, but we can derive it from multiplying correlation by the average variance. So when we pull that in, those are all the numbers that we just walked through. And like I mentioned, we're going to take the square root of that at the end, and that gives us a value of 22.62%, which is going to line up right there with answer C. Question 89. An investment analyst estimates that the stock price of major companies trading at the security exchange market has growth potential. A portfolio manager wants to rely on the advice of the analyst to diversify his portfolio by including stocks of companies trading at the securities exchange market that indicate rapid growth rate in revenue in the last 2 financial years and with a high probability of future investments. Based on his prior experiences with companies in the banking sector and having read numerous news articles, the investment analyst advises the portfolio manager to consider investing in the banking sector instead of the oil sector. The investment analyst is most likely to have displayed which of the following forms of bias. So the bias here is the investment analyst wanting the portfolio manager to invest in banking rather than oil. So what form of bias is causing this? So looking at A, framing bias, I think we can rule that out. Framing bias would come in some form where if the portfolio manager was asking the analyst to look at these two sectors and was asking the question in a leading way where it kind of led the analyst to the banking sector. However, it says the portfolio manager just wants, he wants to rely on the investment analyst and he wants stocks that are growing last 2 financial years. There's not really anything in his request that would lead the analyst to the banking sector over oil. So I think we can rule out framing. B, hindsight bias. I think we can also rule this out as well. This is kind of like the I knew it bias. So when we see things in hindsight, we tend to think that we should have or did know that in the moment, when in reality we probably didn't, or else we would have made an investment bet on it potentially. So there's not really anything in here talking about how past investments or past events have happened that are causing him to make this recommendation. And then lastly, C, availability bias. This is going to be our answer. And the key here is the first sentence of this. So based on his prior experience with companies in banking and having read numerous news articles, availability bias is kind of coming off of the analyst's own experiences and knowledge. So because he maybe has more of a banking sector expertise, he knows those companies better, so maybe feels more comfortable and is going to be more biased towards recommending them over oil, which he's maybe less familiar with. So this is going to be C, availability bias. Question 90. Bruce Craig is in the business of trading steel in Chicago, which he inherited from his father 1 month ago. His financial advisor notes the following aspects of his situation. He's 24 years old. Investment horizon is 10 to 20 years. His primary objective for investing is aggressive growth. His business returns are not stable as he is not able to take prudent business decisions. Given the information above, which of the following statements is correct? Craig has A. A low ability to take risk, but a high willingness to take risk. B, a high ability to take risk, but a low willingness to take risk. Or C, high ability to take risk, but a high willingness to take risk. So we're looking at ability versus willingness based on this information up here. So looking at ability first, looking at a couple things. So he's 24 years old, long time horizon. Those would kind of go more so in favor for higher ability to take risk. But this last bullet point here is what's really going to lead him to take having low ability to take risk. If he doesn't have a stable income, he may have to draw on his investment portfolio. So that's going to leave him to have low ability to take risk, because often the business and economy might follow what the stock market is doing as well. So if his business isn't doing well and he's invested too aggressively, then he may be in kind of a double whammy situation where his business is down and so is his portfolio, and then he's having to draw out of a down portfolio. So having a volatile business or income in general is going to be a big hit on your ability to take risk. And then from a willingness standpoint, he's young, long time horizon, objective is aggressive growth. So I'd say his willingness is high, but ability is low. So for A, we've got low ability, high willingness. That's going to be our answer. B, high ability, we can rule out for that. And C, high ability, we can rule out for that. So we'll go with answer A.